Well, ladies and gentlemen, this does not look like it is getting any better. In fact, it is getting way worse, and we got to break down what's going on. We'll talk about some stocks, some earnings. We'll break down the April jobs report very quickly, and I want to go over kind of where my head is at, what I'm looking to do in these markets. But before we do, hit that like button, subscribe, take a sip of your coffee, of course, and make sure to get your free money from Moomoo, up to 5 free shares of stock, each up to $3,500. All you got to do is use my link down below, deposit at least $100, and just like that, you get your free money, and you also have a chance at 1 free share of Twitter. Again, use that link down below. Let me adjust myself real quick, guys, and let's get right into the video. So check it out. It is about 10:15 a.m. on the East Coast right now, and all of the indexes are down pretty much almost 2%, over 1%, that's for sure. The Dow's up, or rather down 1.2%. We have the S&P down 1.5%. The NASDAQ 100's down 1.7%, as we have the Russell down 2%, and we have the VIX back over 10% on the day thus far, guys. VIX is back to, where is it? Right around 35. Holy crap. Let's pull that VIX chart up very quickly. This is approaching the highs from about 4 days ago when it hit 36.60, and if you guys take a look on this 4-hour chart, it usually, considering, or just looking at this data we have here, it usually tops at about 37 to 39. It hasn't really gone much above that over the past couple of months. Let's see how high it got during the COVID crash. Holy crap, the VIX got to 85. I forgot about that. Wow, the VIX got to 85. So, judging on that, it could always go higher, but to say it's going to go to 85 again, that would be pretty ridiculous in my opinion. But historically, it has gone 80, 85 multiple times. It got to 170 back in 88. It got to about 90 in 08. It got to, where was it? Again, 90 just recently in the March 2020 crash. So it has gotten ugly in the past. But considering we're only at 35, for it to get to 80, it would have to be a complete and utter catastrophe. Something completely left field. Black swan has to occur. So I'm not saying that's going to happen, But anyway, it is pretty elevated where we are now, so keep that in mind. But it could always go higher, maybe towards 40, and we'll see. If we get that black swan, which you can't call a black swan out, guys. Hence why it's called a black swan, right? If you guys don't know what that is, go look it up. So VIX is up right now a lot. All the indexes are down a lot. Geez, look at this, guys. SPY's about to take the lows out. Lows were at 405 from the beginning of this month, 4 days ago, and we just got to about 406 this morning, and now we're at 408. If I pull up the intraday chart, it actually got under 406. So we are getting a bit of a relief rally intraday right now. Nothing crazy. It's up about 0.6, 0.7% from the intraday low, but we are getting a relief rally nonetheless. So I'm going to be watching on the 4-hour, guys. If SPY breaks 405, 300s, here we come. That's what I'm thinking in the very short term. 300s, here we come. Probably 390, 395, and we'll see where it goes from there. And when it comes to triple Q, let's pop that up. This already took the lows out. There you go. It already took the lows out. It is down. Well, it went down. Now it's at 309, but it did go down to 305. That was at about 9:55 a.m. on the East Coast. And, look at this volatility, guys. Jeez. It went to 305. Now it's up to 309. That is a move of 1.4%. So very wild swings here. And look, pre-market, it was at 315. So it went from 315 to 305. It lost 3% just like that in about an hour, 2 hours, not even. And then it rallied 1.5% in the past 20 minutes. So these markets are ridiculously volatile. Again, triple Q broke the lows. You guys can see that clearly. And who knows, maybe it starts going towards the 290s. That's still on the cards. I mean, this is still a falling knife. Same with SPY, so we could always go lower, guys. Keep that in mind, when we're in falling knife territory, which right now in real time we are. So let's talk about the April jobs report. Non-farm payrolls grew by 428,000 for April, a bit above the Dow Jones estimate of 400,000, and identical to March, I guess. Back in March they did 428,000. Either way, 428,000 for April. That beat the estimate. The unemployment rate held at 3.6% after being expected to nudge lower to 3.5%. So that, I guess, is pretty much in line, 3.5, 3.6%, same difference, right? And leisure and hospitality led the job growth, adding 78,000 roughly jobs. We had manufacturing add 55,000, transportation and warehousing add 52,000 jobs, professional and business services 41,000, financial activities 35,000, and we had healthcare at 34,000. So we are adding jobs. And again, non-farms beat the estimate for April, not too bad, and unemployment rate's pretty much right in line, 3.5, 3.6%. And the bad thing here is, guys, wages. Let's talk a little bit about wages, inflation. Wages rose 0.3% for the month, and we're up 5.5%. Not good, guys. 5.5% from a year ago. Let me add that. I don't want to skimp you guys on that part because that part's important. 5.5% from a year ago, about the same as March in terms of that monthly wage increase. But a year ago, it only has risen 5.5% from a year ago, which inflation is over 8%. So if your wages, that's the problem, right? Wages have not increased as much as they used to, a long time ago. And that's the problem in terms of a lot of millennials, people in their 20s, 30s right now. They have so much debt. Student loans were rising. Not to get off topic, but student loans were going up in a way. A lot of people are suffering from student loans. Large amounts of student loans, and you could argue some of that, a lot of that was a ripoff. I'm not going to get into that in this video, and the wages are not increasing the same. You get out of college, you get a $40,000 job, but you have 100, 150, some people have even more than that, $1,000 in debt, when back in the day, 40, 50 years ago or whatever, 30 years ago, you could go to college for whatever. I mean, my parents have told me, I've heard from people in their 50s, 60s, right? You could go for like 5,000 or whatever. It depends, right? I don't know. And you can make money and then you could pay it off, or you could pay your way through college and work through, you guys know, right? If you're older watching this video, not saying you're old, but if you're older in age, whatever, however you want to put it, right? You know what I mean, right? I'm not that old. I'm only in my mid to late 20s, but hey, just talking from what I've heard, right? So, that's kind of what's going on. April jobs report. Let me know your thoughts in the comments. Smash that like button if you haven't done so already. And make sure to subscribe. We're almost at 25,000, guys. Let's now talk about some stocks. Let's talk about DraftKings. DraftKings is down 2.7%. They reported earnings this morning, and the earnings were not that bad, and the stock actually shot up. Look at these wild swings, guys. Holy crap. This stock shot up to $16, and it went down to 13 by 9:30 a.m. or about 10 p.m. or 10 a.m. on the East Coast. So it shot from 16. It went from 16 to 13. That's a drop of 18%. And now it's fighting over $14. So DraftKings is obviously a money-losing company. They're losing money hand over fist. And that is why the stock has gotten destroyed. Look at this stock. It was $74 back in March of 2021, and it just hit 13. It is down 82% from all-time highs, right? Very, very bloody stock here, guys. And full disclosure, I actually do own DraftKings as a speculative position. My average cost is right around, I'm not scared to admit it, guys, $34, $35, something like that. I don't check my long-term positions every day, so I can't memorize my average cost. I've mentioned this before. There's people that obsess over their long-term investments. We're not going to get into that in this video, but if that's one of you, if you're that person, you got to be careful, because if you obsess over your long-term investments, every single day in terms of just keeping your eyes on your account. That's all I'm saying here. I mean, obviously you could think about, what you want to invest in next or stocks you're looking at, but if you're very, in on your account, looking at it every day, every minute of the day, that's going to make you do something stupid, right? That's why I don't really like to look at it. I just set it and kind of forget it, and I throw money, I add a little bit, obviously I think about it, but in terms of looking at the account, and DraftKings, yeah, I'm not scared to admit it, I am down a lot. I'm down a lot, but the thing is, it is a spec play for me, and I have an amount of money in it that I'm willing to lose. That's something that you guys have to realize with these spec plays. It's stupid to go in all the way on them, in my opinion. You could do whatever you want, but I think it's stupid, and this is a reason why it's stupid, because if I did that, if I went all in, I would be screwed, because this is now down again about 80% from all-time highs. Anyway, I'm done preaching, guys. I feel like I'm preaching in this video. No more preaching, Stas. Come on. DraftKings revenue $417 million versus $414, so they beat on revenue. Again, they're losing a lot of money. Q1 adjusted EBITDA loss was $290 million roughly versus the loss of $139 a year ago. So year over year, they're pretty much doubling that loss, which is not good. But like I always say with DraftKings, guys, they have to put a lot of money in marketing, a lot of money to acquire customers, and it's just a never-ending cycle, it feels like, at least as of now. Obviously, one day they want to be profitable, but right now it is just not possible. There's so much, there's so many new competitors coming in, so they all got to fight for the customers. It's a big market, massive market, but they all got to compete, and marketing is one way, the major way that they do that, obviously, right? So they're losing a lot of money compared to last year, but they raised their full year 22 revenue guidance from 1.85 to 2 billion, from that originally 1.85 to 2 billion. Now it is looking to be around 1.925 billion through 2.025. So they bumped it up a little bit, and the estimate was 1.98 billion. So pretty much right in line, a little bit above the estimate for full year revenue guidance for DraftKings, which I'm liking because, again, I own the stock, and obviously I want it to do well long term, and I'm holding it long term. I'm not looking at this thing for the next couple of years. If I lose all my money, whatever, it's not the end of the world whatsoever, guys. But if I 10x somehow, which might not even happen, but let's say I 3x, I'm like, all right, cool, hey, 3x, why not? And there's the I'll take the profits, there's my money, and then I'll invest it in something else, right? That's how it goes. And they're expecting adjusted EBITDA loss from 925 to 825, that general window there. From that point to 840 to 760 million for full year 22. So it looks like they're adjusting their EBITDA loss. They're expecting to lose less money now for full year 22, which I guess is good. So keep your eyes on DraftKings, guys. Ticker symbol DKNG. Not a bad report. Obviously, I'm going to dive deeper into it. Maybe I'll make another video about it. Maybe not. I don't know. But since I own the stock, I'm going to look deeper into it later on today. That's on my to-do list. So that is DKNG. The next one here I'm looking at is McDonald's, which, believe it or not, McDonald's is up now 0.6%. And I'm noticing this stock has been holding up nicely this past month, really. It's been consolidating for the past month, holding this 180 SMA on the 4-hour chart and maintaining this inverse head and shoulders. Look at that, guys. Left shoulder, head, right shoulder. If this right shoulder plays out, watch out for McDonald's to make a move towards 270, right? There could be more upside. Keep your eyes on that. Seriously, guys. Another one that I'm looking at is Cigna. Let's pull that up. This one's up over 5% on the day. Looks like they might have reported today. Let's pop it up. Yeah, it looks like they reported today. They ended up doing, let's see here, $3.68 EPS for the quarter, which is up from $3.30 a year ago. So they crushed their year ago EPS. But I wonder what the estimate was. Let's see here. Not really seeing the estimate. Actually, no, I got to look down a little bit. There we go. Adjusted EPS. So that was unadjusted. Adjusted, though, they did $6.01 versus $5.18 estimated, so they beat that. Revenue, $44 billion versus $43.41 billion, and it looks like they raised guidance. So they're raising guidance, double beat. What else can I say, guys? Cigna is off to the races, up over 5%. This is looking like it wants to take the highs out. The highs are at 269, almost 270, and right now we're in the mid 260s. So I'm going to pull up my phone really quickly. Let me pull up earnings whispers and see if we had anybody else report today that we could quickly talk about. Under Armour, that's the last one. We'll cover Under Armour, and then we'll, oh my goodness, guys, look at that. And after this, we'll wrap the video up. Under Armour is down 23%. What the heck is going on, guys? Holy crap. That is, that's wild. And the thing is, I've noticed, I've been looking at Under Armour stock. You know, we cover a lot of stocks during earnings, and I've always noticed that this one has been very volatile during earnings. You know, look at this. You know, a couple months ago, a couple reports ago, it went from $17 to $23. A couple days after earnings, you know, 18 to 23, and it goes in different directions. Some earnings, it rips up 20%. Others, it's obviously like today down 20%. So let's take a look at what's going on here. Then we'll wrap the video up. Make sure you guys smash the like button if you haven't done so already. This is a disaster. Q1 adjusted EPS of -1 cent, down from the 16-cent profit a year ago. So year over year, they're now down in the negative for adjusted EPS. And sales were about $1.3 billion, up only from $1.26 a year ago. So barely growing sales year over year. And let's see here. They see full year 22 or 23 rather, sales growth of 5 to 7% year over year, adjusted EPS of 63 to 68 cents versus the 83-cent estimate. So that's well under for adjusted EPS guidance for full year 23. That is not good. And it looks like they're just missing on all metrics, guys. It looks like they missed on Q4 revenue. Looks like they missed on EPS for guidance. You know, it's just not looking good. Complete disaster. And I'm sure Under Armour, although I haven't done a huge in-depth analysis on it, I'm sure it's getting affected by the supply chain problem, by the recession that I do believe we're in. You know, I'm not for sure saying 100% we're in a recession, but I feel like we are personally, you know, based on kind of, you know, what I've been seeing these past couple of weeks, really the past month or two. I've thought this. I've mentioned this before many times on the channel, guys. You know, and recessions hurt the consumer. Inflation, there's not as many dollars to go around. People aren't buying as many products. Sure, a lot of rich people are probably still, you know, out and about spending money, but a lot of people, the vast majority of the you know, middle class America is getting affected right now, and companies like Under Armour are going to feel it. So that's it. I think we ran a little bit too long for this morning video, about 17 minutes in. If you guys stuck it through, I appreciate it. I appreciate it if you did. If you did find value, hit the like button, subscribe, drop me a comment, join my Patreon if you're watching this on YouTube, guys. I appreciate it. And make sure to get your free money from Moomo. I'm telling you, it's free money up to 5 stocks, each up to $3,500. Just use my link down below, deposit at least $100, and you could get up to 5 stocks and a free share, a shot at a free share of Twitter. Use that link down below. I'll catch you guys in the next video. Thanks for watching. Peace out.